Welcome to the deep dive. Let's just cut to the chase. If you're trying to generate income in this 2025 investment climate, well, you're probably feeling the squeeze a bit.
Yeah, no kidding.
Interest rate anxiety is, it's still hanging around. Geopolitical stuff keeps throwing curveballs. And even REITs, usually pretty reliable, seem kind of on shaky ground.
Mm-hmm.
But look, our job isn't just to talk about the turbulence. It's to, navigate it. So today, we're really diving deep into the data, trying to uncover some potentially overlooked opportunities.
Right.
Specifically, two REITs that honestly look like the market might be discounting them pretty significantly. Could be compelling for retirement income growth.
Exactly. We've sort of filtered through all that market noise, and we've pinpointed two REITs that, get this, currently boast an average dividend yield of about 6.3%.
Wow, okay, 6.3%.
Yeah. And what's really interesting isn't just the yield, which is obviously juicy, it's their price to FFO multiples. They just seem low.
Right.
It suggests a real disconnect, maybe, between the market price and their actual ability to generate cash. Makes you wonder, why so cheap? Is this a real opportunity for investors?
Right. Now, it's understandable if REITs make some people nervous right now, especially with all the chatter about interest rates. And yeah, it's true. REITs can react to those shifts.
Sure, they can be sensitive.
But think about it. Sometimes that exact fear is what creates potential bargains, doesn't it?
Absolutely. When everyone rushes for the exit, sometimes really valuable assets get, caught in the stampede. Prices drop below what the fundamentals might actually justify.
And maybe we should just zoom out for a sec. Remind ourselves why REITs are often, a key part of a portfolio, especially for retirement planning.
Good point. Beyond that crucial income stream, they can also offer a hedge against inflation, right? Because rental rates often adjust over time. And historically, if you pick the right ones, REITs have delivered solid long-term capital appreciation too. So yeah, the current market jitters are real, but you don't want to throw the baby out with the bathwater, so to speak. Dismissing the whole sector might be a mistake.
Okay, good context. Let's get into the specifics then. Explore these potential opportunities. The first REIT that looks, potentially absurdly cheap is Medical Properties Trust. Ticker is MPW.
Yeah, MPW. What jumps out immediately are the numbers. You're looking at a current dividend yield of around 6.8%.
Okay, 6.8.
And combine that with a price-to-FO ratio sitting at roughly 5.5 times. Market cap is about $3.3 billion. And like the name says, they're in healthcare specifically. They own hospitals.
It wasn't always seen this way, though, was it? I mean, my understanding is MPW used to be a real, dividend darling for REIT investors. So what changed? What happened?
Yeah, that's a really crucial question. It shows how market sentiment can just swing, sometimes pretty dramatically, even if the core assets still have value. MPW has definitely faced a wave of negativity.
Right.
They've been hit by short sellers, their credit rating got downgraded, and there were, legitimate concerns raised about their balance sheet, especially the debt levels.
Issues with tenants, too, I heard.
Exactly. Problems with some key tenants, Steward Health being the big one. That really added fuel to the fire. And there were some past related party transactions that raised eyebrows.
Oh.
And probably the biggest hit for income investors like our listeners, they had that pretty significant dividend cut back in 2023, almost chopped it in half, really, to shore up their finances.
Ouch.
God.
Yeah, that dividend cut probably sent a lot of income investors running. But, like we hinted at, there's maybe another way to look at this, a contrarian view. What's the core strength here that might be getting lost in the noise?
Precisely. If you sort of look past the recent storm clouds, the fundamental business model, it's still pretty compelling. MPW owns a big, globally diverse portfolio of hospitals.
Well,
and a large chunk of these are on long-term net leases. Now, the great thing about net leases for an investor is the tenant pays most of the operating costs.
Yeah.
Taxes, insurance, maintenance.
Right, the triple net structure.
Exactly. So that leaves MPW with a much more stable, predictable stream of rent income. So despite all the headlines, that core income engine is still humming along.
Okay, so the underlying business is still functional, even with these, significant headwinds. What steps have they actually taken to try and fix things, address those past issues?
Well, what's encouraging is that management seems to be pretty actively tackling these problems. They've been aggressively selling off non-core assets, kind of simplifying things. They've been actively refinancing their debt to, improve the balance sheet. And they've brought in cost-cutting measures, too, just to get more financial flexibility. It signals they're focused on stabilizing.
And yet, despite those efforts, the market doesn't seem totally convinced yet, judging by that that low valuation.
Exactly. That's the puzzle, right? The fact that MPW is still trading at what looks like a huge discount to the actual value of its properties, its NAV, and under 6 times its funds from operations, that key cash flow measure, it really suggests the market might be maybe overly fixated on the past troubles, not fully pricing in the turnaround potential. And this gap between the valuation and the cash flow generation, that's what makes it potentially interesting for a value investor.
So even after that big dividend cut, that 6.8% yield is still pretty attractive on paper. How should our listener think about that yield now?
It's important to remember, the cut reflected that period of financial stress. But a 6.8% yield now, after that reset, well, you could argue it's potentially more sustainable going forward. So for an investor who maybe has a bit higher tolerance for risk, who believes in the long-term need for hospitals, we all need hospitals, right? And believes MPW can navigate these challenges, well, this could represent a pretty compelling income opportunity, the whole comeback story angle. It seems plausible for contrarian types.
All right, interesting case with MPW. Let's switch gears now. Let's take our deep dive into the second potentially undervalued REIT, NewLake Capital Partners. Ticker is NLCP.
Yes, NLCP. Now, what's immediately interesting here is the sector, cannabis real estate.
Okay. That'll get some attention.
Definitely. So currently you're looking at a dividend yield of around 5.8%, and its price to AFO ratio is about 10 times.
Okay. AFO this time. Adjusted funds from operations.
Right, AFO. It's often seen as a slightly cleaner measure of recurring cash flow available to shareholders for REITs. And NLCP's market cap is quite a bit smaller than MPW's, around $470 million.
Now, hang on. It's really important we clarify something here, because I know some listeners hear cannabis and immediately think high risk, maybe regulatory headaches. But NLCP isn't actually growing or selling cannabis, are they?
No, absolutely not. That's a critical distinction. NLCP is purely a real estate investment trust. Their whole game is leasing properties, mostly cultivation facilities and dispensaries, to licensed cannabis operators.
Got it. So they're the landlord.
Exactly. They're just collecting rent. They own, I think it's 32 properties now across 12 states. And these leases, they're long-term triple net leases.
There's that triple net again?
Yep. So again, tenants cover most property costs. Plus, these leases often have built-in rent increases, little escalators over time.
Nice. Built-in growth.
Provides a bit of organic growth. And crucially, these tenants, these cannabis operators, they pay their rent in cash.
Okay. So if the business model seems pretty straightforward, landlord collects rent, why might NLCP be, flying under the radar for so many investors?
Well, there are probably a couple of key reasons. First, just its size. Being smaller, it often doesn't pop up on the screens of big institutional investors who tend to stick with larger, more liquid companies.
Right.
And second, it's that association with the cannabis industry. Even though their exposure is just through real estate, it can still make more conservative investors a bit hesitant.
The stigma?
Exactly. There's still that perceived regulatory risk, maybe a bit of social stigma around the whole sector, even though NLCP is just the property owner.
But, okay, flip side. From a financial stability angle, NACP looks, a lot stronger than MPW in one really key area, right?
Oh, absolutely. If we circle back to those interest rate worries we talked about at the start, NLCP stands out big time. As of Q1 2025, they reported basically a near zero debt load on their balance sheet.
Wow, zero debt in this environment.
Pretty much. In the current climate of rising rates, that is a huge advantage. It gives them way more protection against rising borrowing costs compared to, a lot of other REITs that are heavily leveraged.
Makes sense. And what about the dividend, that 5.8% yield? Is it safe? Can they grow it?
Yeah, the dividend coverage looks really healthy. Their AFO payout ratio is somewhere in the 70% range, which is generally seen as pretty comfortable. It leaves a good cushion, room for potential future dividend bumps. And they've actually got a track record. Their dividends grown by nearly 20% just since 2022. So it signals they're committed to returning capital.
Okay, another potentially undervalued story here then. What's driving that undervaluation, do you think? if the fundamentals look pretty solid.
Well, it likely comes back to that institutional reluctance we mentioned, just nervousness around anything cannabis related. And also the fact that their stock trades on the OTCQX exchange, not one of the big boards like the NYSE or NASDAQ.
Right. Less visibility.
Exactly. That can limit how many investors even see it or can easily buy it. But, for individual investors like our listeners who are maybe comfortable stepping a bit outside the mainstream, NLCP offers a pretty interesting way to get exposure to the growth potential of the cannabis industry, but without taking on the direct risks of the cannabis companies themselves. You're just the landlord.
Okay, great breakdown of both. Let's try and put these two different stories together now. We've got MPW, the potential hospital turnaround, and NLCP, the low-debt cannabis landlord. Can we sort of summarize those key metrics side by side, help our listeners compare?
Yeah, sure. Let's do a quick Virgil snapshot. For MPW, you've got that higher yield, about 6.8%, but also the higher risk profile tied to tenant health and significant debt, though they are working on it. Valuation is super low, like 5.5 times FFO.
Okay. High yield, high risk, low valuation.
Kinda, yeah. Then NLCP yield is a bit lower, 5.8%, but still very solid. The huge plus is that near zero debt. Risk is more about the sector perception, the cannabis stigma. Valuation is higher than MPW, around 10 times AFFO, but still seems reasonable given the low debt and growth.
Got it. Low debt in each sector, reasonable valuation.
And average together, you hit that 6.3% yield we mentioned up front. And the overall theme for both really does seem to be potentially significantly underpriced by the market right now.
So even though they're both REITs, they really offer quite different paths, different risk-reward profiles, don't they?
Precisely. They almost complement each other in a weird way. MPW gives you that shot at a big rebound in a core sector, healthcare, though it's currently, facing challenges.
Right, a turnaround play.
While NLCP offers growth exposure in a less traditional sector, but with that fantastic safety net of a really strong low-debt balance sheet. So together, maybe they offer a more diversified way to chase higher yields in real estate for retirement income, especially if you're looking beyond, the usual low-yielding stuff.
Now, let's be clear. These aren't exactly your sleep well at night, low volatility type investments, are they? There's definitely a bit more spice here than, say, your average utility stock.
Oh, absolutely. That's a crucial point. We have to acknowledge that. While the potential for higher returns looks appealing with both MPW and NLCP, you have to understand they do come with distinct risks. We talked about them. Tenant finances for MPW, that whole perception and regulatory landscape for cannabis with NLCP. Higher potential reward often walks hand in hand with increased risk. No free lunch here.
And just putting that 6.3% average yield in context again, how does that stack up against what else is out there? Because that number really does stand out.
Well, yeah, if you look at the broader market, the S&P 500 is yielding what? Somewhere around 1.3% right now.
Tiny.
And a lot of the big, widely held blue chip REITs, maybe they're trading at much higher valuations, carrying a lot more debt.
Right.
So in that light, yeah, MPW and NLCP could genuinely represent pretty compelling value if you're an income investor willing to, dig in, do the homework, and accept maybe a bit more complexity.
It almost feels like we've stumbled upon a couple of, I don't know, maybe slightly dented, abandoned treasure chests in the investment world.
I like that analogy.
They might have some blemishes, maybe operate in sectors some folks shy away from, but the potential treasure inside that significant income stream could make them really worth a closer look.
That's a great way to frame it. For anyone feeling that pinch from low yields in more conventional places, these two REITs, well, they suggest there might be some meaningful income possibilities out there if you're willing to explore beyond the usual suspects.
So maybe the final thought for you, our listener, as you're navigating your retirement income strategy. Perhaps it isn't just about playing it completely safe all the time. Maybe it also involves making smart, informed, potentially less conventional choices. And owning income-producing real estate, but without having to deal with tenants and toilets yourself. That might just be a surprisingly accessible and effective path worth seriously considering.
Absolutely. And look, obviously, as always, this deep dive is for informational purposes. We strongly encourage you to do your own thorough research, your own due diligence before making any investment moves.
Definitely.
But hopefully, our exploration today gives you a strong hint, maybe, that there could be more compelling ways to build that retirement income stream than you might have initially thought.